Hey guys, welcome back. Brad here. Today we've got a pretty interesting video for you. Why new investors lose money, or how to get your bleep handed to you in investing. Okay? Now, you might wonder, well, why in the world do I want to learn how people get crushed in investing? Well, Charlie Munger has actually done very well for himself by really focusing on the mistakes that people make in investing and avoiding those mistakes, not by doing brilliant things, but by avoiding stupid things. So let's talk about some stupid things that people do in investing in the stock market. Number one, chasing price. It's a really weird thing about stocks where as the price goes up, as the investment gets more expensive, people like it more. I can't think of any other thing that people buy where they like it more as it gets more expensive. Okay? It's a very silly reason to be buying more of something, simply because the price is going up. So don't chase the price. Okay? Number two, falling in love with your investment. Now, there's a lot of emotion that gets wrapped up with money, right? We really want to do well financially. And when we make an investment, it can be an emotional thing. And we really want that investment to do well. The problem here is that when we really want it to do well, we start to filter the information that we're taking in, and we only look for information that supports the idea that this company is a great investment. And we ignore red flags. And so it can be very difficult to make rational decisions when we have that bias where we fall in love with what we're invested in and we're not able to integrate new information that maybe strikes against that investment. And if we were able to take in both positive and negative information, we may choose to do something different than we would do if we were only taking in the positive stuff. So that's number two, falling in love with your investment. Don't do that. Stay rational out there. Number three, overpaying. Okay? So the goal of investing, you're laying out money today in the hope that you'll get more back in the future. Okay? Now, obviously, what you pay today is half of that equation. If you pay too much today, it's more likely that you're not going to be satisfied with your investment return, with what you get back from that investment. So, in the investment camp that I come from, the value investment camp, it's critically important to buy investments with a margin of safety. Okay, you're getting that investment at a price that's significantly lower than the value of that ownership share of a business. Okay, so don't overpay. Critically important. Number four, not having a plan and sticking to it. Now you see this especially now, where the market, I think at one point it was down 30% from its peak. It seems like we're in a recession, if not heading into a recession. And when things like that happen, when people start to see their portfolio values drop significantly in a short period of time, they act emotionally, right? They think, oh man, this may go down. I might not be able to retire next year, even though we're planning on retiring next year. Or, people just get fearful and they let that fear influence their decision making. So when you have a plan, you can visualize, okay, the market has dropped. It tends to drop around 50% when we have a recession. Recessions happen every 7 years on average. So, what am I going to do when that happens? So it's really important to think through these scenarios and to have a plan for when unexpected things happen. So number four, have a plan and stick to it. And it might help to have a buddy where you have your plan, they know what your plan is, and before you act on anything that runs counter to your plan, you have a conversation with them. So they can kind of talk you off the ledge. They can help you make rational decisions, okay, rather than emotional decisions that are really going to hurt your portfolio. Number 5, having too much activity. So it's really tempting in the markets. I just posted about this on LinkedIn today to be active. Everything about the stock market, the flashing numbers, the red and green colors, the talking heads on TV that are talking up opportunities that you're going to miss if you don't act now. All of that is designed to get you to do things, to buy, to sell, be active in your accounts. And that's really not a very proven way to accumulate wealth over the long term. Warren Buffett once said, money is transferred from the impatient to the patient in the stock market. So, try not to be too active. Think of what you're buying as you're buying a part ownership in a business. And it takes time for business, right? For businesses to grow and to change and for that to impact your investments. You're not trading a piece of paper, right? At least I'm not as a value investor. I think it's a lot harder to be successful if you're very active. Of course, it's a whole other realm. I don't do trading, so I'm not the person to ask for advice about that. But we know based on the track record of people who've been in the markets for decades that less activity tends to work better. So number 5, don't be too active. Number 6, focusing on the wrong things. Like there are so many people right now who are focused on what the economy is going to do. Where are interest rates going to go? What's the Fed going to do? How is this stimulus going to impact the markets? All of these things, from my perspective, are unknown. Like we cannot act on this information because we don't know what's going to happen. Nobody knows what's going to happen on that level. The right thing to focus on, from my perspective, is what is an individual business doing? What's their growth trajectory? What is the price as compared to the value? I'm looking for a pitch right in my sweet spot. I want a PE of 1, a hidden PE of 1, where the earnings per share 3 years from now is equal to the price per share today, something like that. Maybe the future PE is 1. Focusing on the wrong things, it's so common, and it really hurts the portfolio. So figure out what you can control, what you can know, and focus there. Number 7, shorting stocks, okay? Now, when you short, you're betting against a company. You're betting that the stock price is going to go down. Charlie Munger once said, we've been right on every company that we thought was a bad bet, that was going to go down. But we've never been right on the timing. Now, the timing aspect is critical. If you're shorting a company and it doesn't go down for years, it takes years for the market to accurately reflect the value in the price of the stock, you're not going to make money, right? So you've got to realize that shorting, the best you can do is a double, okay? Worst you can do is go bust. And in order to win the game of investing, we have to stay in the game. So shorting, I highly recommend you do not short, okay? If a crash is around the corner, say you're looking at the markets and you think, oh man, it's going to go down a lot more. There's a lot more pain to come. That doesn't mean you should short. It means, have your cash ready for when things are really in the bargain bin, and then you can buy them at that time. So there's ways to bet directionally that don't involve shorting. Number 8, using leverage, okay? So using leverage, you're borrowing money to invest, okay? And the idea is, say you bet on a company and, you bet $1,000 on a company and you think it's gonna double, right? And so next year you'll have $2,000. But if you bet that same $1,000, but you borrow $5,000 on top of that, if it doubles, you could make a lot more. Problem with that is you're also magnifying your potential losses. You could go bust. You could wipe yourself out of the game, and then you can't win the game if you knock yourself out. So be very careful with leverage. I recommend, there's probably some advanced techniques around leverage. I'm sure Warren Buffett uses leverage on occasion, but he does it in a way where he's really protecting his downside. And that's a pretty advanced trick. I do not recommend that for new investors. Leverage is a fantastic way to just destroy yourself as a new investor. And number 9, last one, investing in things that you don't understand, okay? If you don't understand individual businesses, just invest in the index, invest in the whole market. There's plenty of index funds that allow you to do that, where they have a little piece of each company in the S&P 500. But if you are investing in individual companies, make sure that you understand them well enough to know that you're actually getting them at a good price, a price that's significantly less than what they're worth. The only way to know that is to come up with an intelligent guess about what the value is, and that's a whole other thing, business valuation. I really recommend checking out a guy named Aswath Damodaran. He's a professor at NYU. He publishes lots of videos on YouTube where he values individual businesses. If you want to learn more about valuation, I highly recommend checking those out. But in the value investing space, it's called your circle of competence, right? If you are investing outside of your circle of competence, people like Buffett and Munger would say, well, you deserve to lose money because that's gambling. Because you're not basing your investment on, what an intelligent assessment of what that business is going to do, what the business results are going to be over the coming years. So that's it, guys. 9 things, 9 ways that new investors lose money. So as Charlie Munger would say, study these things and learn from other people's mistakes. You don't have to learn from your own mistakes. Thanks for being here. I'll see you guys in the next video.